I don't know if everybody can see the slides.
Yeah.
Are still muted.
Yeah. Sorry about that. Can you hear me now? Is that okay? And I will zoom my PowerPoint slides. Is that okay? So I hope it will be clear for you guys. And let me start now. And I think yeah, I was just trying to speed up my presentation. Sorry about that. Okay, so our research topic is empirical research on ESG factor optimized asset pricing and multi-factor models. And this is our new working papers currently. And so generally, this paper takes the ESG ratings of the all the listed companies in the Chinese mainland stock markets and explores the effectiveness of the ESG non-financial factors and its three factors in the stock share markets, and examines whether the ESG can provide additional information for asset pricing. And empirical results show that adding the ESG factors to Fama-French three-factor model enhances its explanatory power for asset returns, especially for assets with ESG characteristics, where the four-factor models demonstrate the stronger explanatory ability. And so the research significance and the motivation parts, I just generally simplify them into three bullet points. So the ESG investments concept comprehensively consider social sustainability and long-term corporate value, and ESG investment consider more than just the financial data of the companies. So this shifts in investment approach and also impacts traditional logic of asset pricing. And traditional asset pricing models has not specifically considered the impact of ESG and similar information on corporate values, so which this paper will further explore. And the research questions and contribution. So currently there is limited academic literature on ESG as a investment factor, specifically in the Chinese stock markets. And previous studies in the Chinese markets had short ESG data time cycles, making it impossible to conduct stability analysis over the different time periods. Additionally, when the market investors engaging in the ESG investing, whether this shift to the non-financial investment method will affect the patterns of the past asset returns is worth for further exploration. So if the combined ESG factor return rate is significantly non-zero in the A-share market, which is can be understood as the Chinese mainland stock markets. So this paper will thoroughly explore which of the three divided factors plays a role, and whether these three divided factors can explain combine the factors among other related questions. So and the research design, so generally for this working paper, we propose three main hypotheses. So okay, the DCF model posits that asset prices are some of the discounted value of expected future cash flows, with expectation of cash flows being central to asset pricing. The ESG information assists investors to comprehensively forming expectations about the company's future cash flows. So the companies with higher ESG ratings have more robust performance and are expected to generate higher future cash flows. They have longer ability to a stronger ability to resist the risks, prolonging the duration of the cash flow generation. According to the DCF model, companies with higher ESG ratings have a greater enterprise value. So, however, the corporate investments in the ESG practices, increasing the initial operating cost and doesn't have the substantial impact in the short run. So effectiveness of the ESG practice become like the long-term evidence, especially experience in the market or in industry risks. So the first of our hypothesis is the return rate of the ESG factor is significant and positive, with the risk premium remaining even after the risk adjustment. So the hypothesis one proposed the existence of the ESG premium in the Chinese mainland stock markets. So where the traditional financial theory attributes this excess return of the market risk compensation for systematic risk burning by assets with higher ESG ratings. So if the ESG factor yields a significantly non-zero return and remains significant after risk adjustments using the pharma friend three-factor model, which means our hypothesis one holds, indicating the ESG can provide additional explanatory information for asset returns beyond the three pharma friend factor models. So the second hypothesis is, so this paper suggests that the ESG investments affect the sizing facts in the stock markets, with the effectiveness and stability of the size factor in the Chinese stock market significantly reduced in the recent years. Adding ESG factor into the pharma friend three-factor model expected to enhance its explanatory power. So our third hypothesis in this section is, so the supply side reform policy issued during the 2016 and 2019 in China had led the market to focus more on the long-term sustainability of the companies. Investors have clear expectation for companies with excellent ESG performance, leading to increased investments in such assets. But ESG-oriented investment affects the sizing facts in our stock market. So the ESG investment changed the rules of asset pricing, favoring the investment in higher market value companies, which significantly different from the historical phenomenon of the stock market investor favoring in trading smaller value stocks. Therefore, the ESG investments may affect the underlying assets of the size factor in the stock market. So that is come to our third hypothesis. So for the data introduction and the sources, this study sample encompassed primarily all of the listed stock shares in the Chinese stock markets. And you can download all of those detailed information from the China Stock Market and Accounting Research database. And the Sino Securities ESG rating data is used in this working paper. And for the data processing, so the stock pool includes the main board of the Shanghai Stock Exchange and Chinex board and main board of the Shenzhen Stock Exchange. So combining the Shanghai and Shenzhen is called so-called the Chinese mainland stock market, which you can also call like Asia markets. So the stock are calculated using the right adjusted method for returns, and portfolios are constructed using univariate and double sorting method with stock with either equal or market value weighted. So in line with the pharma French factor construction method, this study sorts the firms by market values and ESG scores using asset combination with the double sorting process to stimulate the ESG factors. So the more detailed the steps and the process to constructing the ESG factors in this slide. And generally the formula is showing, like the formula 3.1 is showing the construction method and for the ESG factors. So and then so in order to test the second hypothesis, we add the ESG factor into the pharma friend three-factor model to expand it into a four-factor model, as shown in this PowerPoint slides. So now we come to more interesting parts, which is our empirical result and discussion. So firstly is about the univariate construction analysis of the ESG factor. So the stock in the testing period sample pool were divided into 10 equal parts based on their ESG ratings, and the return of each asset portfolio were calculated and subjected to significance testing. So as shown in the table 4.1, so the ESG factors constructed by the univariate grouping failed to pass the significance test. To test the robustness of the ESG factor, so this study repeated the augmented univariate ESG factor validity test in the 2016 to 2019 period, during which the both economic and statistical significance of the ESG factor returns significantly increased. And during this period is the launch of the supply side reform plans and has the profound impacts on the Chinese enterprises and industrial patterns. So okay, and then the analysis of the ESG construction through the double sorting. So during the 2011 to 2020 decades, the ESG factor constructed using 3 bivariate grouping methods on all yielded positive returns and all passed the significance test, with the market value weighted method achieving an average monthly return about 0.4%. So between the 2016 to 2019, the ESG factor constructed using the double sorting, which is also significantly non-zero, and they're passing by 5% significance test. So, and with the positive sign and the value increase compared to the full period. So, the market value weighted achieved on average monthly return over 0.4%, supporting our hypothesis 1. And okay, now in the table 4.5 is like the summarized table, and this descriptive statistics is showing that the monthly average return of the ESG factor is approximately 0.37, and which is like slightly weaker than those Fama French pricing factors. And then now the factor correlation test. So from this table, the ESG inversely and significantly correlated with the SMB size factor, and also strongly correlated with HML and other value factors. So in the Chinese market, many value stocks are among the companies with the high ESG ratings, suggesting that ESG investment doesn't conflict with the value investing. It can be inferred that the stocks with the high ESG ratings in the Chinese market tend to have larger market capitalizations, and investing in such assets passively reduce the investment in the small cap stocks, and thereby affecting the performance of the size factor. So now, the risk adjustment test for the ESG factors. So from this table, the further testing is conducted to determine if the ESG factor still presents a risk premium after the risk adjustment. As shown in this table, overall 3-factor model fails to adequately extend the ESG factor. So the risk adjusted return of the ESG factor remain significantly and positive. So with average monthly return of 0.4%, which is similar to the ESG factor constructed using the double sorting method, which supporting our hypothesis 1. And then, okay, and then, the comparison method employed for the models is the GRS test. And according to the table, so the multi-factor models after we add the ESG factors, so exhibits the lower GRS statistics, indicating it has the stronger explanatory power for the stock share assets. So thereby confirming our second hypothesis. So okay, so before we come to the relationship between the SMB and ESG, so I start with the bivariate grouping assets analysis. So firstly, from this table 4.10 is clearly showing you the portfolios with higher ESG ratings tend to have a larger market values. And from the table 4.11, under the same ESG ratings, these 25 underlying asset portfolios exhibit a size effect, with a small cap portfolios outperforming the large cap portfolios. So, under the same ESG ratings. It means that the size effect still efficient and exists. So now, so the ESG investment and size effect, the regression result in this following table shows that after adding the ESG factor, the risk premium of the size factor SMB re-emerges, indicating that the size factor hasn't disappeared in the stock market. So like during this period, the Chinese economic and transformation accelerated, freezing out the traditional lagging production capacities and significantly increasing the market industry concentration, the enterprise with excellent ESG performance are more likely to survive, and those with higher ESG ratings become more attractive to investors. So this leads the investor to passively reduce the investment in the small cap companies when making ESG investments, and thereby affecting the performance of the size factor and weakening the size impact in the Asia stock share market. So now is followed by sections about some ideas about how to improving the ESG negative screening strategies.
And Sinian, we should also make our way towards the conclusion. Just want to make you aware of the time.
Okay, just to go faster through the figures. So as it proving that to invest in the large cap stock for the ESG investment is not a good idea, because there is not significant overlapping. But however, if you transform investing ideas into investing in the medium and small cap stocks, so it's showing you very significant gaps. So it means that to improving the ESG negative screening, it recommends the investors to invest in the medium and small cap shares. And then, so that is the conclusion part, which is summarized in the few bullet points. So the ESG is significantly influential in the stock market, and importance grew during the supply side reform, and because we have more stricter environmental policy in China. So okay, so now I think I can stop there. Thank you guys, and thank you for listening.